Understanding unlisted bonds. What you need to know in 3 minutes. Welcome to StockRhino. You've probably heard of corporate bonds and government bonds, but what about unlisted bonds? They're one of the most talked about fixed income instruments among high net worth and savvy investors. In this video, we'll explain what unlisted bonds are, how they work, their benefits, risks, and how you can invest in them smartly. What are unlisted bonds? Unlisted bonds are bonds that are not traded on stock exchanges like NSE or BSE. They are issued directly by companies, NBFCs, or government-backed institutions to raise capital from investors. Since they're not listed publicly, they are bought and sold over-the-counter, OTC, through authorized dealers or platforms. Why companies issue unlisted bonds? Companies issue unlisted bonds to raise funds quickly without going through listing formalities, offer flexible interest rates and terms to investors, avoid exchange compliance costs. Who can invest? Unlisted bonds are typically targeted at high net worth individuals, HNIs, corporate treasuries and family offices, experienced retail investors who understand credit and liquidity risk. How unlisted bonds work. Here's how it works. A company issues bonds with a fixed coupon rate and tenure. Investors purchase these bonds directly or through registered dealers. The company pays interest periodically monthly, quarterly, or annually. Types of unlisted bonds. There are several types of unlisted bonds available in India, such as corporate bonds issued by private companies, NBFC bonds issued by finance firms like Edelweiss or IIFL, tax-free PSU bonds from government entities. Key features. Key features include fixed or floating interest rates, tenure ranging from 1 year to 15 years, tradable through registered bond platforms. Benefits of unlisted bonds. Benefits include higher returns than traditional bank FDs or listed bonds, predictable income through regular interest, lower market volatility since they don't trade daily. Risks and limitations. But they're not risk-free. You should know. Liquidity risk. Selling before maturity may be difficult. Credit risk. If the company defaults, repayment could be delayed. No stock exchange transparency. Prices aren't publicly visible. Taxation. Unlisted bonds are taxed like any other debt investment. Interest earned is added to your income and taxed at your regular slab rate. If you sell before 3 years, it's short-term capital gain, taxed as per slab. How to buy. You can buy unlisted bonds through registered online bond platforms, SEBI-authorized brokers or wealth managers, direct purchase from NBFCs or corporates during private placement. Example scenario. Example. An investor buys 10 lakh worth of unlisted bonds from a reputed NBFC at 9% interest for 5 years. They receive 90,000 interest annually and 10 lakh principal at maturity higher than what most bank deposits offer. Smart tips. Smart tips before investing. Stick to AAA or AA-rated issuers for safety. Avoid unknown or unrated companies. Don't invest all your capital, use only a portion of your debt portfolio. Who should invest? Unlisted bonds are ideal for HNIs seeking higher fixed income returns, retirees looking for regular income, investors diversifying beyond mutual funds and equities. Key takeaways. To recap, unlisted bonds offer higher returns with moderate risk. Issued privately by companies and NBFCs. Less liquid but more stable than equities. Want to learn more? Visit our website